Friends, next we'll discuss method of depreciation. The first method is straight line method. This method is also known as fixed installment method. Why it is known as fixed installment method? Because every year the depreciation amount will be same. An equal amount or a constant amount of depreciation is written off every year. Every year depreciation will be the same amount under straight line method. How we calculate the depreciation under straight line method? From the cost of the asset, deduct the residual value, you will get depreciable amount, then divided by life of the asset. That is the depreciation per annum. We know how to calculate the cost, purchase price including non-refundable duties and taxes, directly attributable cost, and initial estimate for dismantling, removing, etc. And from that you deduct the estimated residual value, what the amount you will get at the end of the useful life of the asset. That is an estimation. Deduct that amount, you will get the depreciable amount, and divided by the useful life of the asset, you will get depreciation per annum. Next, how to calculate depreciation percentage per annum? That is the depreciation percentage on cost of the asset. So depreciation divided by cost of the asset into 100, you will get depreciation percentage per annum. If the depreciation percentage is given in the question, then you compute that percentage on the cost of the asset, because the depreciation percentage is calculated on the cost of the asset. Therefore, if depreciation percentage is given, apply that percentage on the cost of the asset, you will get depreciation for the year. Under straight line method, what will be the book value of the asset at the end of the useful life? At the end of the useful life, the book value of the asset will be equal to the residual value of the asset. Why? We calculated the depreciable amount. How we calculated the depreciable amount? By deducting the residual value from the cost of the asset. And therefore, after the useful life of the asset, after depreciating in all the years, the book value of the asset will be equal to the residual value of the asset. If there is no residual value, then the book value of the asset will be equal to nil after the end of the useful life of the asset under straight line method. So under straight line method, depreciation is calculated cost of the asset minus residual value divided by useful life of the asset. Depreciation remains same every year. You will see a question. The purchase price, the acquisition price of an asset is rupees 20,000. Wages for installation rupees 15,000. Repairs after the asset is put to use 16,000. Residual value of the asset after its useful life 5,000. Useful life of the asset is 5 years. Compute the book value of the asset after 4 years of life. How we calculate depreciation under straight line method? The formula is cost of the asset minus residual value divided by useful life of the asset. How we calculate the cost? Purchase price including duties and taxes plus directly attributable cost plus initial estimate of or dismantling and removing and restoring the site, that is an estimated amount. In this question, purchase price is directly given 20,000 plus wages for installation, because that is a directly attributable cost incurred to bring the asset to the condition capable of operating as intended by the management. It's a directly attributable cost. Therefore, the cost is 20,000 plus 15,000, that is 35,000. The repairs after put to use, that is not a capital expenditure, that is a revenue expenditure. Expenditure incurred after the asset is put to use, that is not a capital expenditure, that is revenue expenditure. Therefore, that 16,000 is not eligible for capitalization. The cost of the asset is 35,000. Residual value is directly given, that is 5,000. Therefore, depreciable amount is cost of the asset minus residual value. Therefore, depreciable amount 30,000. The useful life of the asset is 5 years, and therefore depreciation per annum 35,000 minus 5,000 divided by 5 years, 6,000 per annum. So depreciation for 4 years, because we have to compute the book value after 4 years, and therefore depreciation for 4 years 6,000 into 4. Every year depreciation remains same under straight line method. Every year 6,000. Therefore 6,000 into 4 years 24,000. Therefore, book value after 4 years will be the cost of the asset 35,000 minus depreciation for 4 years 24,000, and the balance is 11,000. That is the book value of the asset after 4 years. It's a simple calculation. 35,000 minus 5,000 divided by 5 years will get 1 year depreciation, that is 6,000. For 4 years, 6,000 into 4, 24,000. Deduct the depreciation from the cost of the asset, 35,000 minus 24,000, 11,000. You will see another question. Purchase price 20,000, wages for installation 15,000, repairs after put to use 16,000, residual value after useful life 5,000. Useful life of the asset 5 years, compute depreciation percentage per annum. The same question, we have to calculate depreciation percentage per annum. We have to calculate the depreciation percentage on the cost of the asset. Depreciation per annum is 6,000. We already calculated that. 35,000 minus 5,000 divided by 5 years, that is 6,000. Then percentage, how we calculate? Depreciation per annum divided by cost of the asset into 100. Therefore, 6,000 divided by 35,000 into 100, that is 17.14%. The depreciation percentage has to be calculated on the cost of the asset, and therefore in any question, any depreciation percentage is given, that percentage should be applied on the cost of the asset. To find out the depreciation per annum, we should apply the depreciation percentage on the cost of the asset. You will see another example. Purchase price 20,000, wages for installation 15,000, repairs after put use 16,000, depreciation percentage 10% per annum. Compute depreciation per annum and compute book value after 3 years. In this question, depreciation percentage is given. If depreciation percentage is given, apply that percentage on the cost of the asset. We know the cost of the asset, purchase price plus wages for installation, that is 35,000. So depreciation per annum 35,000 into 10%, that is 3,500. Under straight line method, every year depreciation remains same. We have to calculate book value after 3 years, and therefore 3 years depreciation 3,500 into 3, that is 10,500. Deduct the 10,500 from the cost of the asset. Cost of the asset is 35,000. 35,000 minus depreciation for 3 years, that is 10,500. So 35,000 minus 10,500, 24,500. That is the book value after 3 years. In any question, depreciation percentage is given. Apply that percentage on the original cost of the asset. We will see another example. X Limited acquired a machine on October 1, 2017 for rupees 14,000 and spent 1,000 on its installation. Depreciation 10% on original cost, that is to be provided. The books are closed in every 31st March. Show the machinery account and depreciation account for the first 3 years. The asset was purchased on October 1, 2017. The company follow financial year, April to March financial year. The machine was purchased on October 1, 2017. And therefore, the first year in 2017-18 financial year, the asset is eligible only for 6 months depreciation. That is October, November, December, January, February, March. 6 months depreciation for the first year. The cost of the asset is 14,000 plus 1,000, 15,000. 15,000 into 10% per annum, 1,500. But for the first year, depreciation is only for 6 months. That is 1,500 divided by 2. That is only 750. Or we can calculate like this: 14,000 plus 1,000, 15,000. 15,000 into 10% into 6 by 12. That is 750 depreciation for the first year. The machinery account will appear like this: 1st October 2017, the company purchased machinery, therefore to bank 14,000. Same date installation expenses incurred, to bank 1,000. The accounts closed on 31st March 2017 for the first year. 2018 for the first year. Depreciation for that year, 6 months, will be 750. And therefore the balance is 15,000 minus 750, 14,250. That amount is brought forward to the next year, to balance brought down 14,250. And the year end on 31st March 2019, the depreciation for that year, the full year depreciation, that is 1,500. Under straight line method, depreciation is calculated on the original cost, that is 1,500, and therefore the balance during the year is 12,750. And that balance is brought forward to next year, 1/4/2019, 12,750. And the depreciation for that year, by depreciation, the full year depreciation 1,500, and the balance is 11,250. You will see how the depreciation account appears. 31st March 2018, first year depreciation to machinery 750. Depreciation is a nominal account, and therefore that should be charged to profit and loss account, transferred to profit and loss account by P&L 750. And for 31st March 2019 to machinery, the full year depreciation 1,500, and that is charged to profit and loss account, transferred to profit and loss account by P&L 1,500. And 31st March 2020, same as to machinery 1,500 by P&L 1,500. We will see next method, that is written down value method. This method is also known as reducing balance method or diminishing balance method. This is the most commonly used method in the industrial undertaking. Income Tax Act allow only this method, except for the undertaking which are engaged in generation and distribution of power. For them, income tax allow straight line method. Otherwise, every enterprise has to follow written down value method for income tax purpose. Under written down value method, depreciation is computed by applying a percentage on the opening balance of the asset. Every year we should provide depreciation on the opening balance of the asset, plus if there is an addition, on addition also we provide depreciation. Under this method, the value of the asset will never extinguished. You will see an example. An asset was purchased for ₹40,000 on 1/4/2010. Wages for installation 10,000. Calculate depreciation for 5 years if depreciation is 10% on written down value. So total cost is 50,000. First year depreciation 50,000 into 10%, that is 5,000, and therefore the balance for the first year is 50,000 minus 5,000, 45,000. And for the second year, the opening balance is 45,000. Apply 10% on that 45,000. Depreciation for the second year is 4,500. And therefore, the balance is 45,000 minus 4,500, 40,500. Third year, apply 10% on 40,500, and therefore depreciation for the third year is 4,050, and the balance is 40,500 minus 4,050, that is 36,450. In fourth year opening balance 36,450, apply 10% on 36,450, that is 3,645 depreciation. The balance is 32,805. And therefore, fifth year opening balance is 32,805. Fifth year depreciation 32,805 into 10%, 3,280 approximately, and therefore the balance is 29,525. We calculated depreciation for 5 years. Or alternatively, we can calculate like this: year 1, 50,000 into 10%, 5,000, and therefore the balance is 50,000 into 90%, because 10% is already depreciated, and therefore balance is 50,000 into 90%, that is 45,000. On that 45,000 we apply again 10%. So easily we can do like this: 50,000 into 90% into 10%. We'll get second year depreciation 4,500. And for third year depreciation, 50,000 into 90% into again 90% into 10%, you will get third year depreciation as 4,050. And fourth year depreciation, 50,000 into 3 times 90% into 10%, that is 3,645. For fifth year, 50,000 into 4 times 90% into 10%, 3,280. If you want to calculate 10th year depreciation, 50,000 into 9 times 90% into 10%, you will get 10th year depreciation. We will see another example. X Limited acquired a machine on October 2017 for rupees 14,000 and spent 1,000 on its installation. Depreciation is 10% per annum that to be provided. The books are closed in every 31st March. Show the machinery account and depreciation account for the first 3 years under written down value method. The same question we have done for straight line method. That should be calculated as per written down value method. The machine was purchased on 1st October 2017, and therefore first year it will be eligible only for 6 months depreciation. The cost of the asset is 14,000 plus 1,000, 15,000. We will see how the machinery account appears. It was purchased on 1/10/2017 to bank 14,000 and also incurred installation expenses to bank 1,000. Total 15,000. First year depreciation, that is 10%, 15,000 into 10% into 6 by 12, 6 months depreciation 750, balance is 14,250. Brought forward that balance to the next year, 14,250. Apply 10% depreciation on 14,250. That is the difference between the straight line method and written down value method. Here we provide depreciation on the balance, not on the original cost. So 14,250 into 10%, full year depreciation 1,425. The balance is 12,825. Brought forward that balance to the next year and calculate depreciation for that year. 10%, 12,825 into 10%, 1,282 by depreciation, and calculate the balance, that is 11,543. We will see how that appear in the depreciation account. To machinery, first year 750, second year to machinery 1,425, and third year to machinery the depreciation amount is 1282. Every year that should be transferred to profit and loss account, because depreciation is a nominal account that should be charged to P&L every year, by P&L, by P&L, by P&L every year. You will see the third method, sum of the years of digit method. Under this method, the depreciation is computed by applying the following formula: cost of the asset minus scrap value into number of years remaining including the present year divided by n into n plus 1 divided by 2. N is equal to number of years. First we calculate the depreciable amount, that is cost of the asset minus scrap value, and that is the numerator, and multiply number of years remaining including the present year divided by n into n plus 1 divided by 2. N is equal to number of years. For example, number of useful life is 10 years. 10 into 10 plus 1, 10 into 10 plus 1, 11, 10 into 11, that is 110. 110 divided by 2, 55. If the number of years is, useful life is 10 years, the denominator will be 55. Or we can calculate the denominator like this: 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8 plus 9 plus 10. You will get 55. Or you can apply this formula, n into n plus 1 divided by 2. We will see an example. Purchase price of the machine is 1,10,000. Wages for installation 5,000. Residual value after the useful life is 15,000. Useful life 10 years. Compute depreciation for 10 years under sum of years of digit method. Here the cost of the machine is 1,10,000 plus installation charges 5,000, and therefore 1,15,000. That is the cost minus the residual value 15,000. So 1,15,000 minus 15,000. You will get the depreciable amount, that will be 1 lakh. 1,15,000 minus 15,000. 1 lakh will be the depreciable amount. Useful life is 10 years. We know the formula: cost of the asset minus scrap value into number of years including the present year divided by n into n plus 1 divided by 2. Cost of the asset minus residual value, that is 1,15,000 minus 15,000 into first year depreciation 10 divided by 55. 10 means the number of years remaining including the present year. How many years remaining for the first year? 10 years remaining, including that year 10 years remaining. And denominator 10 into 10 plus 1 divided by 2. 10 into 10 plus 1, that is 11. 10 into 11 divided by 2, that is 110 divided by 2, 55. Or you can calculate 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8 plus 9 plus 10, that is 55. And therefore the depreciation for the first year is 18,182. Second year depreciation, cost of the asset minus residual value, that is constant, into 9 by 55. Because second year, how many years remaining including the present year? 9 years remaining, because the total useful life of the asset is 10 years. For the second year, number of years remaining including the present year is 9. 9 by 55. You will get depreciation for the second year 16,364. And for the third year 8 by 55, that is 14,545. Like that we can calculate the depreciation for 10 years. You will see how it appears in the machinery account. Machinery was purchased for 1,15,000. First year to bank 1,15,000. First year depreciation, that is we already calculated 18,182. We calculated the balance 96,812, and the balance is brought forward to the second year. We calculated the depreciation, that is 16,364. The balance is 80,455. That we brought forward to third year 80,455. Third year depreciation 14,545. The balance is 65,909. And the fourth year brought forward is 65,909. By depreciation 12,727. The closing balance is 53,182. And the fifth year opening balance 53,182. By depreciation, by balance, like that we calculated sixth year and seventh year, eighth year, ninth year and 10th year. 10th year the balance will be 15,000. What is this 15,000? 15,000 is our residual value. Under this method, the book value after the useful life will be equal to the residual value. Under straight line method also, the book value after the useful life will be equal to the residual value. If there is no residual value, this book value will be equal to nil. Next method, number of production unit method. Under this method, the depreciation is computed based on production or output quantity. Here also first we calculate the depreciable amount, that is cost of the asset minus scrap value, and you multiply into number of units during the year divided by total estimated production. The formula is cost of the asset minus scrap value into number of units produced during the year divided by total estimated production. We will see an example. Purchase price of the machine is 10,000, wages for installation 5,000, residual value after useful life 3,000, estimated production units 6,000. The pattern of production units: first year 1,000, second year 2,000, third year 500, fourth year 1,500, fifth year 1,000. The asset was purchased for rupees 10,000. Wages for installation incurred 5,000. Therefore, total cost of the asset is 15,000. Residual value is 3,000, and therefore depreciable amount is 15,000 minus 3,000. That is 12,000 is the depreciable amount. And we have to calculate the depreciation for 5 years. Total production is given 6,000. The pattern of production year 1, year 2, year 3, year 4, year 5 is given, and therefore the depreciable amount you should allocate to the useful life of the asset on the basis of this production pattern. We know the total estimated production is 6,000. How we got the 6,000? First year 1,000, second year 2,000, third year 5,000, fourth year 1,500, fifth year 1,000. Total is 6,000. And therefore depreciable amount is 15,000 minus 3,000, 12,000. You allocate that. First year 1,000 divided by 6,000, that is 2,000 rupees. First year depreciation 2,000 rupees. Second year depreciation 2,000 divided by 6,000. The ratio is 2,000 divided by 6,000. Third year depreciation, the ratio is 500 divided by 6,000. Fourth year depreciation, the ratio is 1,500 divided by 6,000. Fifth year depreciation is, the ratio is 1,000 divided by 6,000. So first year total depreciation 2,000, second year 4,000, third year 1,000, fourth year 3,000.